It is my pleasure to be with Mike McGlone. Mike McGlone is the specialist in commodities / Bitcoin with a whiff of technical analysis. We're going to have to speak loud because there's something going on with Bitcoin. It's falling apart. And he has some views on oil, interesting views on oil. But I just wanted to give an introduction. Mike, I think it was 4 or 5 years ago, 6 years ago, probably 5 years ago, he came out with the original chart about market capitalization in Bitcoin. And he used it to make the case for, big run-ups and for over 100,000. But you will be surprised right now what he has to say about Bitcoin, about oil, and please feel free to add any other things. So he had a presentation, and he thinks oil is going to
$40 a barrel, Ashraf. And I appreciate meeting you here. This is the Money Show Miami. What are we? June 15th, 2025. Today. There's a little construction behind us. But I have to admit, I was very early on oil in 2022 when it made that big run up above 100. Every time it's gone above 100 in the last 20 years, it brings on the elasticity of supply and demand. It goes down to 40. Now it's a paradigm shift. So I think it's a matter of time it gets below 40. The average cost of production in this country is 50 to 55.
Yeah.
Usually you have to shut down below that to shut off those excesses of supply and demand. And now we have a situation that the supply out of U.S. and Canada is phenomenal. OPEC supply is just kicking in and coming back on. And China demand's declining. It's a bear market. So typically you have to shut down. You have to go to that low price tier. I don't think we're there yet. So today think we got down to 60. And here's what I like to end with. It's the vested interest of the U.S. government to lower crude oil. And Mr. Trump's just coming back from the Middle East and Saudi Arabia. He's going to get what he wants.
Yeah, exactly. And with the Middle East and with the possibility of a peace deal with Iran, and like you said, lower demand and so on and so forth, and probably, the break-even point or the survival point for Saudi is all the way back down to, to $5. I mean, or is it $10 a barrel, right? The only problem is, in order for their budget to break even, oil has to be above 100.
I think it was a good quote from the movie. There's a show in the U.S. called Landman. It was pointed out 60 is a little bit low, 80 or 90 is a little bit high, maybe in between 65, 70 is good. But this is a cycle. Right now we're in a cycle from the high price cure towards a low price cure. It always works out that way, and you usually just don't bottom on a dime. And the key thing, the number one thing I think that's going to affect crude oils is the absolute necessity for the U.S. stock market to go up. It looks like it's starting to tick down from the highest levels in 100 years based on GDP and the rest of the world. So that's what I'm worried about is crude oil showing deflation. Bond yields in China at 1.67, 10-year yields are showing deflation. If the stock market goes down, that's just a normal deflationary cycle, but it's historic because we got so high to the peak of inflation in 2022.
Excellent. Okay, before we go into Bitcoin and maybe S&P or NASDAQ, let's talk about gold. What do you think?
It's got very expensive, about $3,500 an ounce. It's a bull market that got expensive. Just remember, it's a bull market. Good support around 3,000. The number one factor for gold to stay above $3,500 an ounce on the year, which is up 33%, is if the U.S. stock market rolls over. And if that becomes more of a situation that people are aware of, I think the next key level will be 4,000 in gold. Right now, 3,000 good support. But remember the fundamentals, what's happening to gold. Central banks are buying gold. They have been for quite a while, most notably China. Now, Poland was one of the last big buyers. And now ETF buyers are starting to buy. We had 4 years in a row of ETF outflows in gold, and now they're kicking the inflows. So the bottom line is if the stock market stays strong, yields will stay high, why buy gold? But if it's starting to roll over, which I think we're out for that recession we didn't get in 2023, then gold is best performed, one of the best performed major assets this year for a reason. And if you look at gold going up and crude oil going down, that's a major signal of a global recession. And the key final trigger for holding up that recession is U.S. stock market. If it rolls over, that's just that's bull fuel for gold.
Interestingly, some people, it does always act as a substitute with the stock market. If, like we saw in the financial crisis, gold went down with stocks as it was part of a deleveraging, but this time it's different. I know it's a bad word to say that because of the central bank, because of the risk alternatives, and because of the debt in the U.S. That is right. So may I ask you how high it could go in this run-up?
So I think here's a simple, logical place for it to go that usually doesn't work in markets. In a recessionary scenario, Bloomberg Intelligence expects S&P 500 to go to 4,000. That's be a good place for gold, per ounce price of gold, and S&P 500. By the way, that 1-to-1 ratio has been historically where it goes to. It got those two ounces of gold forever for one S&P 500. Now it's kind of it's popping back up in that ratio. So demand's a good spot. We'll see how that works out. But the key thing is, remember, you point out was the issues that are happening with is treasuries and debt, and what's happening with when Russia invaded Ukraine and the U.S. kind of weaponizing the dollar. Gold's a default. And I'm still bullish gold. It got expensive. And the key thing I learned in this business is it's okay to take profits because that's what keeps us alive.
Exactly. Yeah, you're right. Just something in the Middle East, people always love to attribute gold's gains to geopolitics, but there's a lot more to it. I could count it on my hands how many times gold went up on geopolitics. It was basically, the Iran Revolution, 78, it started, and then the Soviet invasion. But if you take, and then obviously more recently, Iran, Israel, April 2024, Ukraine, obviously, in 2022. Okay, yes, and Mike is one of the original people who really look at the gold, Bitcoin ratio, gold, S&P ratio. I actually, in my book, I wrote it, that was written, published in 2008. I was looking at the gold to oil ratio, how it pushes up, and when it breaks higher, that's usually a sign of a downdraft, economically speaking. What do you think Bitcoin is going to go, and why?
So Bitcoin right now is the highest ever versus S&P 500. And I think it is a classic case of the crowd mentality. It's not an asset you want to be buying. I think the systematic risk for Bitcoin going down is extreme. It's very expensive. 2020 is very bullish Bitcoin. It took basically 4 Bitcoins for one S&P 500. Now it's almost 20. It's just way expensive. So the key thing I like to point out is the Bitcoin to gold ratio. It's basically right now about 32 ounces of gold per one Bitcoin.
32.
That's the same as in 2021, yet we don't hear much about gold. We hear about Bitcoin all the time. Just the fact that the rock has been keeping pace with Bitcoin since 2021. That peak, I know it was from that point in time, but it's also been outperforming the stock market. I'm very concerned that Bitcoin can do what it always does in history, drop to zero. Just go back to 10,000. I'm concerned. I have to point out, it's my duty to point out the risks. The key thing is, remember about the key thing that I've published, I like to point out is, still bullish the big picture for Bitcoin. I love the cryptos, what they're doing. I mean, from a U.S. standpoint, the base layer is the dollar, and stablecoins invest in U.S. treasuries. Finally, our government figured that out. It took a little while, but it was kind of silly. I enjoyed writing about that. But now we have the classic pile-on trade. It's really expensive, and I'm afraid it's going to do what Noy does. But here's what I end with. Gold has 3 companions, dependents, or whatever you want to call them, silver, platinum, and palladium. And they're only going up because gold's going up. Because the world's buying, central banks are buying gold. The key thing about Bitcoin, it now has 15 million dependents. Our viewers have probably heard Scott Bessent use an example of the broomsticks in Fantasia, the unlimited supply. There's an unlimited supply of cryptocurrencies. They're all dependent on Bitcoin going up, almost all of them. And that's just a space. There's just so much speculative hubris and volatility in that space that I look at it as when they're selling, you're supposed to be yelling. So I will stick with it. I look at it similar to when I made the call for crude oil to drop to 40 in 2022. It was above 100. I'm worried about the risk of Bitcoin dropping to zero.
And it doesn't matter whether the U.S. first family has a vested interest, whether BlackRock has a vested interest, and so on and so forth. You mentioned the ETFs. I remember I bought my first gold ETF, the GLD, I think 6 months after the GLD was started. It was like that crazy period around 2005, 2006. We had a nice interim decline in gold, 30% in 2006. I remember it was June. It was the last rate hike by by Bernanke. It was the last rate hike, but the market dropped because they were not expecting that rate hike, but then it all took off.
2007, 30%. I was in it.
Absolutely.
Because I did stock market there, like now. I'm way overweight gold, and I just talk about it. But same thing. It dipped a little bit. It dipped a little bit when the stock market dropped in 2008, but stock market was down, 40, 30%. Gold was up.
Interesting. Any Fed cut rates or not this year?
They can't. They can't cut rates.
Diplomatic answer. Will they or not?
Well, that's the fact. So we were priced in for 100 basis points of cuts when the market was on the bottom for this year, and now we're priced for two cuts, which is 50 basis points. The Fed's going to cut. Here's the thing about the Fed cutting is they can't cut because they cut too early last year. The bond market told them to stop. They only did 100. The bond market's telling them they can't cut. Bond yields got to 5% today. That is too high because part of when they cut last year, it helped boost the stock market to the biggest money pump ever. $12 trillion. It added way too much GDP. It's part of pumping inflation, the wealth effect. And now inflation numbers are sticky. Their core numbers for core PCE are up to 3.5% or so. The targets too. They can't cut. There's one key factor that make the Fed cut. Stock market going down. The problem is when they do cut, don't expect 25. Expect 15 more. That's usually how it happens. They cut because when they got it. It'll be got it cutting rather than want it.
Excellent. We could go on forever, not only because of the in-depth of the intellect, but the weather here. Sorry, guys, that we couldn't make this more quiet of the background, but that's what we need. We try to find order in a world of chaos.
But this is a good thing to point out is what you're seeing here, that's construction in Miami. It's everywhere. Yeah, show that. It's everywhere. Yeah. I left New York, you take subway now where my bike everywhere. It's a classic sign of a peak. It's just everywhere too much. I mean, it takes about 5 years typically to get something like going. So the whole housing market, the whole real estate market in this country is rolling over. So it's just a leader. So this is a classic sign. Just one construct. They're everywhere in Miami.
Yeah, and I went to Brick Hill shopping center there. It's pretty amazing, the quality and the quantity. Mike McGlone, thank you very much. I would shake hands with you with my right hand. Actually, let me hold this.
It's a pleasure.
Thank you very much. You can find Mike McGlone. Sadly, his analysis is in the ecosystem of Bloomberg, but if you go to YouTube, if you go to Google, you can always catch the occasional
LinkedIn and X, I post all the time.
LinkedIn and X with Mike McGlone. Thank you very much. Pleasure.
Thank you. Massive supply has been met by finding higher interest rates. There's an old adage in the bond market: there are no bad bonds, there's only bad prices. And if you're going to borrow $2 trillion or $2.5 trillion, we just need a lower price, which means higher yields, and we'll find those people to buy them, and that's what we've been doing.
Father of the bond.